All right. So Bob, welcome. Welcome. You've been in the Facebook group for a long time. You know how this rolls. How are you doing tonight?
Doing good, sir. Thank you.
Awesome. Well, let's get into some questions. Let's talk about COVID. A lot of docs complained a little bit to me that it felt like disability insurance companies were dragging their feet a little bit, especially early in the pandemic, in passing out disability policies. What changes have you seen over the last year due to COVID in how the companies are doing underwriting, how they're issuing policies, et cetera?
Well, first, thank you for having me on Facebook Live with your group. It's an honor and a pleasure. Very good question. So, COVID, and your readers were absolutely correct that when COVID started, what happened was we experienced a rush of applications. You had folks that had contemplated disability insurance. You had folks that were looking into disability insurance. All of a sudden, just go out and make that purchase. And what that did was that created a flood of applications at the same time, which combined with the fact that the staff for these insurance companies were working remote, were not as efficient, created quite a backlog that lasted almost 6 months. And that had purely to do with volume and inefficiencies in the system, where you didn't have 100% of the workforce in the office functioning at 110% as they normally do. So that certainly had some detrimental effect on the issuance of the policies. But to talk about COVID itself, COVID in itself has not affected disability insurance underwriting. Disability insurance underwriting is still the same as pre-COVID levels. Insurance companies have not taken any adverse actions pertaining to underwriting disability insurance. Where we have seen a very big change take place with COVID and underwriting is term life insurance. Term life insurance nowadays is taking 3 to 4 months to get approvals. Insurance companies are very alert and are looking much more in detail at applicants. There are some conditions where you're just an outright decline or a postpone, as they would say in the industry, where they ask you to come back and file an application after COVID's over. Now, some of those conditions are obesity, diabetes, severe asthma, certain types of autoimmune disorders. So when insurance companies are coming across applicants with these conditions, they're resulting into immediate denials. So what we're doing on behalf of our clients is we're doing more pre-screening. We're asking a lot more questions before we allow them to apply, just to make sure that they don't end up with any sort of a negative or a decline on their record. But overall, COVID has not affected disability insurance, except that the insurance company volumes have gone up 20 to 30% since COVID started.
Do you think that's just because doctors have realized that maybe they're not invincible? Maybe they saw a few peers get really sick or even die and decided, I better get this stuff taken care of?
I would say so. I think fear factor is definitely played a very big role in physicians. A lot of times we'll get inquiries from clients and they'll look into, from physicians, they'll look into the coverage and then kind of put it off. Well, wait till I'm closer to graduating residency or fellowship to buy it. Well, all of that changed last year. They just simply were getting quotes and asking us to sign them up.
It's interesting. On the opposite side, a lot of people are more worried, but there are a fair number of doctors that aren't that worried about getting disabled, maybe not as worried as they should be. I saw an article in Emergency Medicine News last month by an emergency physician. It didn't sound like he really ever bought a very good policy, but he seemed disappointed to have ever bought it at all. And believe it or not, his recommendation was just self-insure, essentially. Take that money you would be putting toward premiums and invest it and I guess hope you don't get disabled early in your career. Can you give us some examples of docs that have been disabled early in their career that have been clients of yours, and what are some of the things that can happen to docs to cause them to need to use their disability insurance?
Absolutely. Conventional wisdom says you're more likely to file a claim in the fourth, fifth decade of your life as you progress. However, the reality of the situation is quite different. Now, I'll use my own example. In the last 36 months, I've had 4 claims. The first claim was on a 32-year-old pediatric anesthesiologist who suffered a stroke on a treadmill on a Tuesday night in New York City in a gym. The second claim I had was on a 34-year-old nephrologist who was diagnosed with myasthenia gravis. They found a 6-inch thymoma in his chest, a very debilitating condition. My third claim was on a family medicine doctor. She was 37, and she suffered a stroke on a dinner table on a Friday night. And then my fourth claim just came about a month and a half ago, was this amazing surgeon that I know, 38 years old, 3 beautiful children. He got diagnosed with stage 3 rectal cancer. So, when I see these type of claims on young physicians, it makes you realize the importance of disability insurance more than ever, because, well, let's do the math, right? So a disability insurance policy for a resident can start at $5,000 a month, can go all the way up to $20,000 to $30,000 a month as an attending. And those are guaranteed increases. So even if you had a diagnosis, they would still allow you to increase the policy. So to give you a perfect example, 32-year-old resident signs up for a policy, gets diagnosed with a neurological disorder, becomes an attending, a progressive disorder, calls me up, maxes out his policy at $20,000 a month, and files a claim at the age of 35. Now the insurance company is responsible for paying him $20,000 a month tax-free with cost of living adjustments till he turns 65 years old. If you put a value to that claim is worth millions and millions of dollars, in excess of 10 or 12 million dollars. So the concept of saving the premiums and investing them would really never work, for a young physician. Now, for an older physician that has achieved financial independence, by all means, I agree with that philosophy. But I am a very big proponent of young physicians, med students, residents, fellows, getting disability insurance early in their career and working towards financial independence. And I would gladly wait for the day where they call me up and tell me, Bob, I'm financially independent. I don't need this coverage anymore. But that's really my view on that.
Interesting that all 4 your most recent claims were docs in their 30s, and also that they were medical problems, right? A lot of people think they need disability insurance due to trauma, due to accidents, due to a car wreck or a fall rappelling or whatever, right? But the truth is that most disabilities are medical problems, right? Diseases.
Absolutely. I mean, from what I've seen, absolutely. I mean, truthfully, statistically, musculoskeletal issues are the single largest reason for claims for disability insurance. But in my particular case, I just was very unfortunate to get these 4 claims on young physicians. It was just heartbreaking to see, for example, the anesthesiologist, once he suffered the stroke, he sent me an email with full of spelling mistakes. I mean, you could see that his cognitive skills and dexterity was definitely compromised. And, hey, I want to get back to work in 3 months. Here we are 2.5 years later, and he still has not recovered his fine motor skills. And he's working in an admin capacity, but he's certainly not working as an anesthesiologist.
And he's collecting that entire benefit.
Absolutely.
Yeah.
Absolutely. He's collecting the full benefit as an own occupation claim.
Yeah, I saw an example recently. This was on social media, and it wasn't a disability, unfortunately. It was a death. It was a resident who had died of eclampsia. And why I saw it on social media is they had a GoFundMe going.
Wow.
And so I wrote a post about it, not without specifying the doc, but just pointing out that GoFundMe is not a life insurance company. Well, GoFundMe is not a disability insurance company either, right? I mean, if we're talking about a policy that pays out 2 million or $10 million, right? You're not going to raise that in a GoFundMe. The average GoFundMe is $3,500. It's just not going to, it's not going to get there. You can't rely on somebody else and other people to take care of you in the event of disability. You got to buy a policy and get that taken care of. It's interesting. This article I mentioned in Emergency Medicine News last month by this doc that wants you to self-insure for it. He is of the impression that it's really hard to get the companies to pay you in the event you're disabled, that you're going to have to fight them, hire lawyers, really take it to court, spend years getting them to pay you. These 4 claims you had, how hard was it for the docs to get paid?
Very good question. A question that comes up very often where physicians or young residents that are buying coverage are asking me, the insurance company is not in the business of paying claims. They're in the business of making a profit. What incentive do they have to pay my claim? And to that, I say, insurance companies are required to maintain a loss ratio. And a loss ratio is where for every dollar you collect, you must pay back 50 cents in claims. It's sort of almost like health insurance. So none of these insurance companies are incentivized not to pay your claim. Second is if you purchase a private policy, it is a fully underwritten policy where the insurance company does its due diligence, takes a month, 2 months, 3 months to approve your policy. But once they approve your policy, it becomes a contractual agreement between you and the insurance company where if you have a bona fide claim, they have to pay it. In order for them not to pay it, they would have to prove outright fraud or a frivolous claim. So to answer your question, all 4 of these gentlemen, three male doctors and 1 female doctor, they all filed claims. The insurance companies, there were all different insurance companies. They all did their due diligence in terms of verifying the veracity of the claim, but they paid all the claims. Not a single claim was denied. So it's there are types of policies, right? So you've got group policies that are issued under ERISA law, and then you've got private policies which are fully underwritten and are issued under the auspices of state insurance laws. Now, ERISA-based group policies are much easier to contest and much easier not to pay because of the way the law is designed.
These are the group policies you get from your employer.
Yeah. Correct. And those are the type of policies that you're reading, articles about where the insurance company didn't pay the claim. But private policies, on the other hand, because the company did the due diligence, because the company, knowing what they knew of your medical history, approved a policy, it becomes very hard for the insurance company to back out of that claim because they let you in the door after a full investigation. So all the due diligence was done at the point of application, which then does not leave them too much room to back out of paying a claim. So I really would not be too worried about an insurance company not paying your claim. If the top 5 insurance companies were in the business of not paying claims, I could assure you, you'd read all about it, and I'm quite sure there'd be regulatory action against those companies. I would not hesitate to recommend every young resident, med student, fellow to purchase a disability policy with a quality company. And I could pretty much assure you, if you have a bona fide claim, it will get paid.
Tell us about that due diligence process they do. I mean, you got to prove your income, I assume, send them some tax returns or something. And you got to send them some doctor note signing off that you're actually disabled. Is that pretty much it?
Correct. So the claims process is one that of verification, right? So you're contacting me saying, Bob, I have a policy with you. I've suffered such and such injury or illness, and I'm unable to work, and I would like to file a claim. And that's where we personally get involved and get a hold of the insurance company and get the claim paperwork, and we pass it on to the insured. We do assist insureds with filling out the claim paperwork, but a lot of it is very individualized to that particular claimant and their situation. So once they go through that claims process, we try to take their claim to management just so that they're in good hands and they're treated fairly. Now, once that claim goes into a claim examiner's hands, what they do is they verify, first off, they verify the medical records. They obtain the records from the primary care or the specialist and understand exactly what is going on. They do, they do look at CPT billing codes. They do look at your duties, and they look at a variety of factors, but not with the intent of trying to get out of the claim, but with the intent of establishing an own occupation, right? So, what are you practicing a majority of, and what is the disabling condition that prevents you from doing that? And what else can you do besides your own specialty? Because you do in fact have a own occupation policy that allows you to practice other forms of medicine, teaching, research, even if you're disabled, let's say as a surgeon. So it's a normal due diligence process. It's not that complicated that you need to go hire an attorney. I frankly believe that an attorney should only get involved when an insurance company tells you categorically that for whatever reason they're not going to pay your claim. It is only at that point, because I had an instance where a physician's claim was delayed through his own fault. I mean, they had asked him for documentation, which he didn't provide for 6 months. And then he called me and said, Bob, I'm thinking of suing the insurance company. And I dug into it a bit deeper, and it turns out that he hadn't supplied all the documentation, the income documentation that was needed, because he had transitioned from an academic position to a private practice. But once all of that was submitted, his claim did get paid. And he called me and told me, he goes, Bob, right after I spoke with you, I spoke with a attorney, and the attorney told me, he goes, he was salivating at the thought of, fighting this claim on behalf of the claimant, because he would have taken a percentage of the recovery. Now, this was a permanent claim, and the value of that claim was almost $16 million. Now, to give up a third of that $16 million to the attorney, you'd better be sure that you need this individual and his legal expertise before you go signing a piece of paper where you're willing to sign away a third of your claim value, on a maybe. I'd rather see a outright decline before I approach an attorney.
Hmm. All right. So we were getting a few questions coming in from people watching this. Let's take one from Jess. She has a question about something we've been discussing on the blog a lot recently, about GSI policies, guaranteed standard issue policies. And her question is basically, what do you think, assuming you have some sort of group policy as a resident, what do you think about waiting until the end of residency to buy an individual policy if that program qualifies for a GSI policy that you know you'll be able to buy, even if you develop some health condition during residency? What do you think about waiting in that situation rather than buying an individual policy at the beginning of residency?
Those are two questions, and I'll try to answer both of them in that order. So first off, GSI policies are available to a very limited number of institutions. So not every institution has a GSI offer. Now, most of your GSI offers have a cap on the amount of coverage you can get. So the cap could be anywhere from 5,000 to 10,000. Now, you've got to ask yourself a question, depending on the specialty that you're in, what is your income earning capacity? If your income earning capacity is $300,000, $400,000, $500,000, then that GSI policy is just not going to cut it. Number two, GSI policies are typically priced with unisex pricing. Now, unisex pricing does favor female applicants. However, it does not favor male applicants as much, because what a unisex policy does is, so if you look at gender distinct rates for males versus females, female rates for disability insurance are about 30% higher than male rates because of the higher morbidity experience. So a unisex policy lowers the female rate but increases the male rate. So if you've got a male applicant relying entirely on a GSI policy, issue number one is you're going to end up paying a rate that is higher than you normally would have. Number two, you're going to end up capping yourself at a $5,000-$10,000 policy, which simply will not be enough for you as an attending. Now, what I tell a lot of young residents and fellows is when you're doing your planning, you need to keep your attending needs in mind. Because you're an attending for 30 years, you're a resident for 3 to 5 years. So it's really, your planning should be geared more towards your attending needs, not towards your residency needs. As far as waiting to apply, one of the biggest problems that I see in waiting to apply is the clock is ticking, right? So as a resident, you're working crazy hours, 70, 80, 90 hours a week. You're not eating properly. You're not sleeping properly. You're not exercising. So the odds are against you that you may develop some sort of a chronic diagnosis. And if that happens, that could prevent you from, you could end up with a modification, you could end up with a surcharge, or you could end up with a straight up decline. I'll give you a perfect example. I have a resident who's about to graduate in June, and he approached me now to set up his coverage. Well, it so happens that in January, when he did his blood test, his A1C was 5.9. Well, insurance company considers that to be pre-diabetic, and it's an outright decline. So that is the kind of risk you don't want to take by waiting. If budgeting is a concern, buy a smaller policy, get a graded premium, but get something. GSI policies tend to do very well for folks that cannot qualify for a traditional policy. Look, frankly, if I came across a GSI quote and it was more competitive than a private policy quote, I would encourage that applicant to get the GSI first and then get the supplemental coverage from me. I'd never discourage them from getting a GSI policy if it was in their best interest. But if it's a male applicant who is about to pay unisex rates and in comparison can get a better deal on a private policy and can qualify for a private policy, then by all means, you should be entertaining a private policy versus a GSI plan.
Okay, so let's talk about fellowship here. A couple of questions from Osama. Wants to know, number one, let me pull it up here. Is it possible to get a high dollar disability policy as a fellow, or is it simply based on your income? I think what he's asking is, can I get a $20,000 a month benefit while I'm in fellowship only making $5,000 or $6,000 a month?
No, you can't. So as a resident, your limit is capped at $5,000 a month. As a graduating resident, you could utilize your contract within the last 90 days of graduation in order to get a much higher benefit. As a fellow, you would be entitled to $7,500 a month of coverage, no questions asked. Now, mind you, this benefit is tax-free. So $7,500 a month is, almost close to $85,000 a year tax-free, which is considerably more than what residents and fellows make. A fellow can get more coverage if they're moonlighting. So I just did a policy on an interventional cardiologist, and the guy made $250,000 last year, moonlighting and doing his fellowship. And I was easily able to get him a $10,000 a month policy based off of his earnings. But traditionally, for a fellow that is not moonlighting, it'd be difficult to get coverage more than $7,500 a month unless you were within the 90 days of graduating.
Okay. Another question from him is, can you get a specialty-specific policy, such as interventional cardiology, before you graduate fellowship? And can you explain how that works when you buy a true own occupation policy as a resident?
Absolutely. So let me kind of go back a little bit. So let's say you purchased a policy as a med student. Then you became an internal med resident. Then you become a cardiology fellow. Then you did your interventional cardiology. That disability policy will automatically follow the progression in your career. So the way an insurance company establishes your own occupation is they look at what you were practicing 12 months prior to claim. So you don't need to call me and notify me, hey, Bob, I'm I'm an internal med resident now. Hey, Bob, I'm a diagnostic radiology fellow now. I'm a diagnostic cardiology fellow now. Now I'm an interventional cardiology fellow. The contract automatically assumes the progression in your career. Own occupation for an interventional cardiologist, quite frankly, implies your ability to do your cardiac procedures is your own occupation, because my assumption is that your procedure billing is significantly more than your clinical billing. And so if a majority of your billing is coming from a result of interventional procedures and you lose that ability, almost any true own occupation policy would consider you totally disabled, allowing you to work in a clinical capacity or practicing some other form of medicine, and still collecting the full benefit. That's the beauty of a true own occupation policy for an interventionalist, a proceduralist, a surgeon, for example.
So basically, when they sell it to you, they sell it to you priced according to what your occupation is at the time they sell it to you.
Correct.
But when they pay it out in the event that you get disabled, it's all about what your occupation is just before you get disabled.
That is correct. So a lot of times we'll get someone who is in the PGY3 going into PGY4 of diagnostic cardiology fellowship, and they'll tell us, Bob, I intend to become an interventional cardiologist or an electrophysiologist or do a structural heart fellowship. And I tell them, well, you're in luck, because your rates, that of a internal medicine doc, are lower than an interventional cardiologist. So lock it in as an internal medicine resident, and you will still be covered as an interventional cardiologist as you progress in your career. So you're absolutely right. The pricing is set when you apply. And based on your classification is set based on when you apply. But as you progress in your career, that policy will continue to progress with you.
Okay, very well. And he's got one more question. And this is about a non-true ONOC policy. And he's asking, do you get less disability payment if you're able to work as a physician with a non-own occupation policy?
So to answer your question very technically, most of your private disability insurance companies will not allow a physician to get a non-own occupation policy.
Interesting.
Yes. So Guardian, for example, bakes their own occupation into the contract. Emeritus, for example, wraps their own occupation with their enhanced residual rider. And for physicians, you can't get the policy without those two riders. Principal, on the other hand, sells their regular occupation rider as an add-on. Standard does the same. So it depends on the company that you end up with, but in all likeliness, you will end up, if you have a private policy, it will be an own occupation policy. But let's say you're in that 1% that purchased a principal policy and did not get a own occupation rider. All that means is that you're disabled as an interventional cardiologist, but anything else you do will compromise that benefits value. Depending on what you're earning, they will adjust the value of your claim. And you could be working as a greeter in Walmart, or you could be doing clinical cardiology, or you could be doing telemedicine. Every dollar you earn will compromise a dollar of benefit in a non-own occupation policy.
All right. So let's say you're working as an interventional cardiologist, you get disabled. Now you can only practice regular cardiology. But in that case, you would still get paid out because your own occupation would be interventional cardiologist.
Well, that's a very interesting question. The technical answer to that question is it would depend on what your CPT billing looked like before you filed the claim. So if you're an interventional cardiologist, but you're billing only 20% from interventions, then you would not be considered as an interventional cardiology own occupation. But if you're billing 60, 70% on interventional procedures, and you lose that ability as a result of an essential tremor, and now you've lost a source of almost 70% of your CPT billing, you would be considered totally disabled, even if you were working as a clinical or a diagnostic cardiologist. So it really goes by individual situations, pertaining to the claimant, as to what they were practicing, how much they were practicing before they filed the claim. And that's a moving target, because depending on where you are, and depending on what you're in your practice and the makeup of your practice, you could be doing I've met cardiologists that just all they do is procedures. And then I've met interventional cardiologists that are kind of 50-50. They do procedures and they're diagnostic. So it really depends on the makeup of your practice before you file the claim.
All right. So let's talk about another subject that's been on the blog recently, which is military docs. Now, most of the companies, if they sell you a policy before you go on active duty, they will give you the opportunity to suspend it while you're on active duty. Now, most of the policies say they won't pay for an active war, but obviously there's lots of ways to get disabled that aren't an active war. What would you say to a doc wondering if he or she should suspend their policy as they go on active duty? Would you recommend they suspend it or that they don't suspend it?
It's a very good question. So that will depend on the policy that you own. Right? So let's use principal for an example. Principal policies must be suspended the minute you go active duty. So you really don't have a choice but to put that policy in suspension, and they'll allow you to pick it up to 5 years without any evidence of insurability back once you become a civilian. Now, there are other companies like Mass Mutual and Standard that will allow you to keep your policy active as long as you're stateside and there's no act of war related to the claim. So they will pay that claim. Now, there's a company like Emeritus that is a caveat, right? So they do not require you to suspend your policy as an active duty physician. They will cover you. However, the claim payout will depend on the nature of the disability. So, for example, let's say you were in, your uniform, and you were in a military jeep, and you got into an accident, and the military says you're entitled to a full payment. Well, in that case, Emeritus is not going to pay, even though your policy was active. But if you were off base on a weekend playing football with your friend and you got injured, then they will pay. So it really boils down to the policy that you have. So my recommendation to all active duty physicians is call your broker, have a discussion with him about what your policy represents. What do you have to gain by paying the policy? Or is it redundant to pay that policy? And then make that decision individually based on your condition, based on your situation. If you're going stateside, by all means, call your broker and put that policy in suspension, because you're paying for coverage you're never going to be able to claim.
You mean if you're going overseas?
I'm sorry, if you're if you're not going to be stateside, and if you're going overseas, by all means, take that policy and put it in suspension, because you're not covered. But if you're stateside, definitely have a discussion with your broker to determine your eligibility and your options.
Okay. Here's another rather specific question. This one has to do with Guardian policies. Guardian sells both a basic partial disability rider and an enhanced partial disability rider. Which one would you recommend somebody buy if they were looking at a Guardian policy?
Sure. So partial disability rider is also known as a residual disability. And Guardian has two types of plans. They have the basic. Before, they used to have the select and the premier. Recently, they made a change where they they changed select to basic and premier to enhanced. Now, enhanced implies enhanced features, basic implies basic features. So to answer your question, your enhanced partial disability will kick in at 15% loss of income. So you're still working as an interventional cardiologist, but your back hurts. So you're doing less interventions or working less days, which then results into a 15% loss of income, and you could file a claim. Now, mind you, the reimbursement in enhanced versus basic is different. So your enhanced partial disability will reimburse that claim dollar for dollar, even though it's a partial disability claim. So if you have a $5,000 a month benefit and your loss of income is $5,000, they will reimburse you the full $5,000 under the enhanced. Under the basic, first off, you need to demonstrate 20% loss of income, time, and duties. So it's a slightly higher threshold, but more paperwork versus just 15% loss of income. But the reimbursement is 50% of your benefit amount. So same example, you have a $5,000 policy, you had $5,000 a month in loss of income, they will reimburse you 50% of your policy value, which is 5,000. 50% would be 2,500 a month reimbursement versus enhanced would have been dollar for dollar. Now, there's an interesting change that Guardian made when they introduced the basic and the enhanced plan, which is now they will allow you to interchange riders. They never allowed that before. So if you purchased a basic policy, all you had was basic features. If you purchased an enhanced policy, all you had was enhanced features. So let's say you're evaluating the policy, you're looking at the basic features, you like most of them with the exception of the partial disability rider, well, just ask your broker to run that basic quote with the enhanced partial disability rider. Or vice versa. You like the premier plan, but you don't care about the enhanced partial, well, put in the basic partial. You can interchange it now, which you weren't able to do before. So I see that as a plus. Which one do you choose? That really boils down to your own personal profile. Are you risk averse? Are you a value player? We could definitely make a recommendation, but really there's no set rule that says you should buy an enhanced or you should buy a basic.
Awesome. Well, for those who are listening here, if you have any questions about disability insurance, just type them into the comments below and we'll get them answered. I've only got a couple more questions for Bob here. So when I run out of questions, if you guys aren't asking them, we're going to be done here tonight. So make sure you're putting your questions in there. My next question is a common one I see, mostly because residents don't have that much income and they're looking for ways to save a little bit of money. A lot of residencies now offer a group disability policy. It's very common now for residents to have something provided to them by their employer. What do you think a resident who has a group disability policy available to them should do differently than a resident who does not? Clearly, the one who does not needs to buy an individual private policy. But what about the one that has a policy? Should they still get an individual policy? Should they buy a smaller policy? Should they get it later in residency? What recommendation do you have for them?
So first off, when a residency offers you a group disability policy, you have no choice but to accept it. So it's an involuntary policy that requires 100% participation. So it's not even an option whether you can opt in or opt out. Now, typically, these policies are quite inferior in nature. It's a $2,000 a month benefit. It's taxable. It's not own occupation, has a 6-month wait. So it's not truly a reliable type of coverage. However, for a cost conscious or a budget conscious resident, my recommendation would be to buy a smaller policy. Let's say as a resident, you're eligible for $5,000 a month, but you've got a $2,000 or $2,500 a month residency policy, then purchase a $2,500 private policy. Get something in place. The reason being, if you buy a policy, you will have the guaranteed ability to increase that policy up to $20,000 to $30,000 a month as an attending. So it doesn't matter as much whether you start at $2,500 a month, $4,000 a month, $5,000 a month. So purchase what you can afford. But do something. Don't leave it to a chance, because if you're going to wait till the very end of your residency and you end up with as much as if you're even symptomatic, the insurance company will take that into consideration and either end up giving you a big exclusion or a modification, or even declining your policy, depending on what you're experiencing in terms of symptoms or a diagnosis. So a group policy, good because it's free, not quite reliable, but definitely gives you the leverage to buy a smaller policy versus someone who has no coverage at all, who would need to probably buy a bigger policy.
All right, here's another question coming in from a listener, a watcher, I guess, tonight, since we're on video. It's from Tony asking, if in the future you go part-time, can you reduce the policy coverage amount? I have a standard policy. My wife is principal. We're thinking about going part-time in the future. What do you think about that? How hard is it to reduce your amount if you want to?
Not at all. The insurance companies will gladly take risk off the books, right? So as you're getting older and you're getting more likely to file a claim, now you're asking them to reduce their exposure. They'll gladly do it. So lowering your coverages is not a problem. Now, in this particular situation, for someone who's going part-time and lowering their coverage, it's not at all an issue to lower the coverage and increase it back up again. Now, for someone who is working full-time and calls me up and says, hey, Bob, I want to reduce my policy, you may want to concern yourself with the loss of the increase rider. So a lot of these policies have a benefit update rider, the benefit purchase rider, the benefit increase rider, and that is tied directly into your income. So they look at a percentage of your income. They look at, they take typically 60% of your income, and they look at that figure and compare it to how much coverage you have. Now, if you fall below 75% of that amount, 75% of that 60%, they will take that increase rider away from you. So sure, you could decrease that policy, but you'd better be prepared that you'll never be able to increase that policy again because you've lost the rider. Or let me rephrase that. You would be able to increase that policy again, but you'd be subject to full underwriting, right? So what that rider does is it protects your insurability. It allows you to increase the policy even if you had a chronic diagnosis on your record. And let me also answer this question a different way. If you did go part-time, yet you kept the premiums up for that policy that was more suited for your full-time income, they will pay you the full benefit if you get disabled. So you purchased a $15,000 policy as an attending when you were full-time. Now you went part-time and you're making $100,000 a year, but you continued paying for that $15,000 policy. If you get disabled, the insurance company will pay you the full benefit, regardless of the fact that you were making a lot less when you filed a claim. So decreasing, absolutely doable, easily doable. But again, you want to make sure that that decrease is not going to result into a loss of that future increase rider in case you feel that you may end up needing more coverage in the future. Obviously, if you're financially independent and you're cutting down your coverage, it's a non-issue.
Awesome. Okay, let's talk a little bit about discounts. Now, discounts that some agents have because of the volume they send to a given company or because of their experience, the time they've been in the field, make it very hard to shop for disability insurance. It turns it from less of a commodity where you're getting the same price from every agent and makes you feel like you got to shop around and check with multiple agents. How should somebody deal with the presence of discounts when shopping for disability insurance?
Short answer, take advantage of them. I mean, look, if I'm quoting a premium of $100 a month and somebody else is quoting you that same exact policy at a lower premium, I mean, why wouldn't you? I'm a big proponent of value pricing. And quite often I have referred potential clients to GSI programs where they can get a better rate or someone who's offering a better discount than the one I have access to. So I am not at all opposed to the idea of value pricing and purchasing your policy from an individual who's going to deliver the best value. Now, what we have done is we've pretty much negotiated the highest discounts that are allowed by law with these insurance companies. One, because of the amount of years that we've been in the business and the relationships with it that we have with these insurance companies. Two, because of the volume. For example, I have a 15% for attendings, 20% for residents, a white coat reader discount. So by all means, if you can get a discounted value, go for it. And if I'm evaluating coverage from somebody else and I see a discount in there that I can't offer, I'm not afraid to tell my client to go to that other broker and secure the policy. Why not? I mean, disability insurance, unlike term insurance, is expensive. So every percentage of discount that you can get on that premium matters.
Tell me more about this white coat investor discount.
Yeah. So what I did was, as we do with all insurance companies structure their discounts differently, right? So Guardian, for example, associates the discount with the institution where you're training, right? So you could be a resident, and if your institution's not on their list, they're not giving you a discount. Principal, on the other hand, offers multi-life discounts. Now, what they'll allow you to do is if you have more than 3 participants in a particular practice, institution, faculty, they will extend you discounts. So we've established those discounts with almost every major institution and faculty out there. But to talk about the white coat reader discount, I went to Emeritus and I basically, told them that, hey, look, we have an ability to access, the white coat investor community. But again, there are a lot of med students and residents and fellows on limited budgets looking for value. What can we do for them? And I was lucky enough that they came back and said, well, for every trainee, we'll give you 20%, plus another 10% preferred occupation discount, depending on what your specialty is. Or we'll give a 15% discount to every attending that signs up through you. And we'll call it a multi-life discount. Multi-life being multiple lives coming from white coat investor group.
So all they have to do is go through you to get that. They don't actually have to prove they been reading the blog for 4 years.
No. Would you like me to do that? I could.
Yeah, send them back. Let's do that.
Now.
Tell them they gotta pass the financial literacy test to get that discount.
Perfect.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.